There's a company out there that has its fingers in a whole lot of pies. Fingers that are on speed dial to some of the most powerful people in the world. Fingers that command trillions of dollars of capital and can direct societal change, whether we like it or not. Now, you might not be familiar with this company, but there's a strong chance that you and your money are connected with it in some way. So today, I'm going to give you everything you need to know about this firm and how it has an effect on all our lives. So, this cannot be missed. Before I begin this oration about capital allocation, I need to impart some important information. I'm not qualified as a financial advisor in any nation, so this video is only for your entertainment and education. Speak to an actual financial advisor if you're worried about your financial situation or your portfolio's fluctuation. If you're joining us for the first time, my name is Guy and I'm so glad to see you stopping by. Here at the Coin Bureau, I talk crypto and other related topics morning, noon and night. If you want regular insight, hit the subscribe button and the little bell down there on the right and voila, you've seen the light. Okay, that's the small print done and dusted. Let's find out what this company is and what it's been getting up to. The company that I'm talking about is BlackRock. And if you've not heard of it, you're in for a treat. BlackRock is the largest asset manager in the world with over $10 trillion in assets under management. Yep, that's right, trillion with a T. It's also a relatively new company, by Wall Street standards at least. BlackRock was founded in 1988 by a man named Larry Fink. Now, Larry has investment banking and finance running through his veins. That's because prior to founding BlackRock, he worked as a mortgage bond trader at First Boston. He did well for the bank and, by some estimates, made $1 billion in profits for it between 1984 and 1986. Not surprisingly, this made him something of a star there. However, in 1986, he got into a wrong-way bet on interest rates and his division lost $100 million, which took some of the shine off his reputation. Long story short, Larry eventually left First Boston to start his own firm with funding from the Blackstone private equity group. Larry's new firm became the asset management arm of Blackstone. It grew quickly, AUM swelled, and after a buyout of the remaining Blackstone shares, changed its name, in a moment of sheer inspiration, to BlackRock. In 1999, BlackRock became a publicly traded company and continued its rapid expansion in the asset management sector. In 2006, the firm acquired Merrill Lynch's asset management business, which rapidly expanded its offerings in the equity sector. This was further compounded by the purchase of Barclays iShares in 2009. At $13.5 billion, this was one of the biggest deals in asset management history. As a result, BlackRock quickly morphed from being a bond asset management company to an index fund provider. For those unfamiliar, index funds, sometimes called exchange-traded funds, are collective investment vehicles that track the performance of a particular index or basket of securities. They're hugely popular, not only because they're easy to invest in, but also because they incur lower fees than more active investment management firms. It's these benefits that have also made index funds extremely attractive for other more passive institutional investors, the most common being pension funds. Trillions of dollars of money invested on our behalf find their way into index funds of some sort. That's why I wasn't kidding when I said that it's more likely than not that your money has been invested through BlackRock in some way. Either that, or it's being invested by another index provider thanks to BlackRock's technology. More about that in a bit. The point is that BlackRock is a behemoth, a 500-pound gorilla that invests on behalf of hundreds of millions of people. And what that means is that it has an interest in nearly every company you can think of. And that's not hyperbole either. Given that BlackRock has to invest funds to track indexes or other investing themes, it must invest in the underlying assets. If these funds track an equity index, it means that BlackRock must take a stake in the underlying company. And what this means is that BlackRock is often one of the largest shareholders of a company's outstanding shares. This is something you can easily see for yourself. For example, how about we take a look into the largest shareholders of some of the biggest Wall Street banks? Goldman Sachs, JP Morgan, Bank of America, Citibank. BlackRock is one of the top 3 shareholders in every one of these companies, a key stakeholder in banks that keep the financial markets running. Or how about the media? Well, a look at the cap structures of Comcast, Viacom, and others shows that BlackRock is there too. Okay, perhaps you don't read the mainstream news. You get your info from the internet and social media platforms. Well, BlackRock has large stakes in Google, Apple, and Twitter. When it comes to the food we eat, BlackRock is there too, holding stakes in McDonald's, Chipotle, and others. Now, I could go on, but I think you get the point. Along with State Street and Vanguard, BlackRock forms a trio of the largest shareholders in the vast majority of publicly traded companies in America. For example, according to a recently published paper by CorpNet, these big 3 asset managers are the largest shareholders for over 90% of all companies in the S&P 500. It's crazy, right? It's not only on the S&P 500, though. If we were to take a look at a broader collection of all outstanding publicly traded companies, 40% of them have these 3 as their biggest shareholders. You can see exactly what this looks like in this handy visualization. 1,600 American firms with their networks of ownership. It's not only American companies, though. Given that BlackRock offers index funds in Europe that are exposed to European stock markets, it holds considerable positions in companies across the pond as well. And these are just for the publicly traded stocks. You might also be surprised to learn that asset managers like BlackRock have also been competing with you when it comes to residential real estate. It was reported last year that large institutional investors were buying up entire property units to diversify their holdings. Now just imagine that. Large asset managers could potentially be using your pension money to outbid you on a home. And despite how crazy all this sounds, it's just the tip of the iceberg. That's because BlackRock has not only made a name for itself through its index funds, it's also developed an institutional investing platform that is the backbone of the asset management system. A, quote, central nervous system that's relied upon by nearly every billion-dollar capital allocator. This is BlackRock's Asset, Liability, Debt and Derivative Investment Network, or Aladdin for short, and props to whoever came up with a name that makes such a fine acronym too. Aladdin is a system that had its beginnings not long after BlackRock was first launched. It was initially developed as a time-saving system that BlackRock could use to automatically report on bond positions. However, it's grown over the years to become the operating system for the company itself that inhabits multiple data centers and is maintained by a group of between 1,500 and 2,000 people. Aladdin has become so integral to BlackRock's internal risk management systems that it's used by around 13,000 BlackRock employees all around the world. Now, the exact mechanics of how Aladdin works are beyond the scope of this video, but the basic MO is that it's a risk management platform that runs advanced Monte Carlo simulations, yep, I had to look those up too, to get an adequate picture of the scope of risk in a portfolio. Aladdin became so sophisticated that BlackRock saw an opportunity to start making money from competing asset managers, institutional investors, and corporates by making the platform available to them. It would also allow these investors to manage their portfolios and model the inherent risk. Now, the list of companies that use Aladdin is vast, with over 240 external clients currently relying on the platform. Companies like Google, Apple, and Microsoft use it for their corporate treasury management. The $1.5 trillion Japanese government pension fund is also a client, as well as, get this, State Street and Vanguard. That's right, BlackRock's biggest competitors are effectively paying to use BlackRock's own systems, and in the process, giving BlackRock access to reams of data about their portfolios. Data that further helps BlackRock to refine Aladdin and better model risk. So, quite simply, although these firms may manage funds separately under their own AUM, their portfolios are linked up to BlackRock systems. Talk about having an edge. To say that Aladdin is an important system in the global management of assets is an understatement. Back in 2020, It was estimated that about $21.6 trillion sits on the platform. In 2020, that would have been higher than the entire GDP of the United States. Or perhaps another comparison. If you were to empty the bank account of every one of the 7.6 billion people in the world, every single bill and coin, and place them all in a pile, it would be worth around $5 trillion. So, what this means is that Aladdin has grown into a system that is responsible either directly or indirectly for over 4 times the value of all the money in the world. Now, is it just me, or is that pretty damn scary? No, it doesn't make investment decisions, but its risk models inform the investment decisions of all of those who use it. There have been many who have questioned whether this system poses a systemic risk to the market. For example, given how many managers rely on its analytics and modeling, does this create complacency and reliance that could give off a false sense of security? What happens if there are false or erroneous readings? It's a computer model after all. This is something that was raised as far back as 2013 by Stanley Pignall, the Economist's finance correspondent. He likened it to the reliance of all the banks on the supposed risk analysis of those credit ratings agencies back in 2008. We saw how well that turned out for the financial markets. And speaking of the financial crisis, what have I told you that BlackRock was a pretty instrumental player in the bailouts and deals that took place around that time? A key advisor to other banks and the government itself. You see, not only is BlackRock a massive asset manager that controls one of the world's most powerful computers, it also offers advisory services. It's called Financial Markets Advisory, or FMA, and it was actually born out of the financial crisis. That's because it was during that time that BlackRock realized its expertise could be used by other companies and government departments. Back in 2008, when the subprime mortgage sector was failing, there were numerous banks on the edge. Banks that had portfolios of stuff that no one could value. Well, almost no one. Given the expertise that BlackRock seemed to have with these opaque instruments, let's not forget Larry Fink used to trade them, there was a view that it should be called in to value some of these assets. These services were first used by the Fed Bank of New York when it asked BlackRock for advice in valuing the assets that were held on the balance sheet of Bear Stearns. Now, this is important because the New York Fed provided a credit line to JP Morgan so that it could purchase Bear Stearns. So, it's fair to say that the assessment of those Bear Stearns assets was crucial not only to the deal, but the risk involved of the Fed offering a credit line to JP Morgan. And this wasn't the only thing BlackRock was contracted to advise on. The broader Troubled Asset Relief Program, or TARP, made extensive use of its services. For those who don't know, TARP was the government program that purchased these toxic assets from the financial institutions to shore up their capital. Some of the biggest recipients of this included the likes of AIG, Citigroup, and Bank of America. BlackRock played a central role in not only advising these companies, but also the government. Larry Fink also held several calls with both Tim Geithner and Hank Paulson, the NY Fed president and Treasury Secretary at the time. I'll leave a link to this Vanity Fair article in the description. It details the work that BlackRock did at the time. Quite illuminating. Of course, these connections that BlackRock had during the financial crisis and the role that it played did raise some eyebrows in Congress. But the machine kept chugging along. Then, almost 11 years after the financial crisis, we had another emergency. This one brought on not by subprime mortgage bonds, but by the pandemic. Except this time, the spending was many multiples larger. If you'll recall, the Fed embarked on an unprecedented bond buying program and monetary stimulus. I'm talking trillions upon trillions of dollars that were used to buy back not only Treasury securities, but more risky corporate bonds and mortgage-backed securities. And of course, they needed the advice of someone who knew about these types of securities. Thankfully, they had the industry experts on speed dial. It was later disclosed that BlackRock was central to the pandemic response. According to this New York Times article, Larry Fink was in constant contact with both Jerome Powell and Steven Mnuchin in the days before and after the announcement of the Fed's stimulus program. Take a look at this table here. It breaks down the recipients of the Treasury Secretary's calls over the weekend of March the 21st to March the 22nd. The person who he called the most, 9 times in total, was Jerome Powell. However, coming in at number 2 is Larry Fink with a total of 5 calls, almost double the number of calls that Mnuchin had with the president. What's even crazier than this is the fact that Larry was the only individual on this list of people who wasn't a government official or lawyer. Now, of course, these could all have been above board, and Mnuchin could merely have been asking for his advice as the CEO of the largest asset manager in the world. However, it does raise a few eyebrows regarding Larry and BlackRock's influence. This influence, of course, extends to the Fed's bond purchase programs themselves. According to a contract that was posted in March of 2020, the Fed had hired BlackRock to help with the corporate bond purchase program. Although there was a lot more transparency about the terms of the deal compared to its work back in 2008, it still meant that BlackRock was instrumental in that bond buying program. Whether there was any other firm capable of handling the volume the Fed was looking for is uncertain. But of course, it does again show how reliant these officials have become on this behemoth of Wall Street. So, it's clear that BlackRock has political influence, or at the very least, a line into some really powerful people. But what's perhaps more concerning about the firm is the power it has and intends to exert over corporate boardrooms. As I mentioned before, BlackRock, and the top 3 asset managers more generally, are the largest shareholders in hundreds of Fortune 500 companies. What this means is that not only do they own the shares, but they also get board representation. These corporate boards are designed to help advise on company strategies, and board members can have much more of a say in a company's strategic objectives. Given that BlackRock invests on behalf of clients, it is considered a passive investor, i.e., it's merely tasked with allocating capital and voting in the best interests of shareholders. And up until a few years ago, that's exactly what it did. However, in 2018, it changed tack. That's because it was at this time that Larry Fink wrote a letter to the CEOs of some of America's largest public companies. This was the first salvo in his pitch to better contribute to society. Quote, "Society is demanding that companies, both public and private, serve a social purpose." Now, this was a novel idea at the time, but has since shaped the mood around investing based on ESG, or environmental, social, and governance principles. The main MO behind this investing methodology is that companies should no longer just be graded on their bottom line, but also on how they impact society. This letter was a big deal. You had one of the most powerful investors on Wall Street saying that it would be using ESG criteria to grade companies. Everything from their climate change records to diversity on their boards. Some wondered whether BlackRock really would carry out these plans for a more activist role. Any doubts on the matter were laid to rest with some controversial shareholder votes. For example, last year, BlackRock disclosed that, as ExxonMobil's second largest shareholder, it was backing board changes proposed by an activist hedge fund. The fund in question was Engine Number 1, and it's been trying to get ExxonMobil to move faster in the reduction of its carbon footprint. The activist investor only held about $50 million in stock, but had proposed some board members who Exxon claimed didn't possess the requisite skills to serve on the board. Only a few weeks ago, BlackRock also backed similar initiatives by voting against a board director of an Australian oil and natural gas producer called Woodside Petroleum. The reason for the vote was because the company was not outlining targets for emission reductions to its customers. In fact, according to this Wall Street Journal article, for the over 1,000 proposals for the year ended in June 2020, BlackRock backed 6% of environmental proposals, 7% of social proposals, and 17% of governance proposals. According to Rich Fields, quote, BlackRock has strongly signaled that quiet diplomacy is not the only tool in its toolbox. We expect more votes for shareholder proposals and against directors in this and future years. Now, some of you may be saying, what's the big deal, Guy? It's for a better future. Well, let me elaborate. One of the biggest problems with this approach is that it operates on the assumption that meeting these ESG criteria could be complementary to the shareholder returns objectives. However, this is often not the case. That's because meeting these criteria may come at the expense of potential company performance and hence long-term shareholder returns. For example, in the case of the Exxon proposal, yes, in theory, we want solutions that are going to help reduce long-term emissions. But unless these standards are applied to all competing companies in the field, you're hampering some to the advantage of others. There are many oil and gas companies out there that are private or listed elsewhere. Companies that don't have BlackRock as a shareholder and hence don't have to worry about meeting the same standards. They can compete as much as the law allows them to, and sometimes to the detriment of Exxon. This could lead to a fall in the value of Exxon shares and hence the company as a whole. Now, the same principles can of course be applied to the S and G angles of the ESG strategy too. Then, of course, you have the administrative burden and unpredictable way in which this ESG mandate is managed. This is something that companies have complained about, given that these board votes came without warning or clear rationale. There are so many boards that BlackRock sits on that it could be hard to apply proper due diligence to these ESG votes. According to Ali Saribas, a partner at shareholder advisory firm Squarewell Partners, quote, BlackRock's approach will fuel a rising frustration among companies that believe BlackRock's stewardship team will most likely apply a tick-the-box approach given the sheer volume of companies they passively own. Essentially, the approach that BlackRock wants to take could hamper the efficient performance of a company's board and corporate strategy, which of course is not good for that long-term shareholder value. But beyond the additional burdens that this could place on companies, you have the question of whether a company like BlackRock should be having such a large say in the way that society is shaped. Have all of the stakeholders, the millions of us who have pension funds and invest in ETFs, been asked how we feel about these proposals? Are stakeholders polled on each and every one of these proposals? And how do we know there's not a broader political agenda that could seep in should the winds of public opinion shift? Does this create a precedent for other large companies to follow suit? Now, these are all relevant questions that need to be answered. It is, after all, good governance. Time for a few of my final thoughts here. I always knew that BlackRock was a powerful company, but it wasn't until I dived into the research for this video that I realized how far that power extends. As the world's largest asset manager, it manages an ocean of capital that gives it immense control over the financial system. Given that it's the owner and operator of one of the largest and most important asset management platforms, many would argue that it's too big to fail. In fact, I would counter that it's now too big to control. That's because BlackRock seems to be taking on a new mission that's beyond mere capital allocation. The firm is looking to use its ESG mandate to shape the way that corporate America is run. It's also not as if politicians can really do much about it. Given the connections that BlackRock has with all of these higher-ups, it is more likely to call the shots than the other way around. Of course, the mandate and goals of BlackRock may be benevolent and sincere. But you have to question how this power could be used in the future, should it fall into the hands of someone who would use it for more than just ESG benchmarks. Money is power, after all. And given that BlackRock controls so much money, it has absolute power. And as the saying goes, absolute power corrupts absolutely. Wow, that was a long one, but there was a lot to unpack there. Now, I'd love to get your feedback though. So what are your thoughts on BlackRock and its ESG mandate? Do you think that it has too much control? I'd love to hear your thoughts in the comments below. Also, while you're down there, I have something extra special for you. It's my dedicated socials page, which has all the official links to the following: my Telegram Insider channel with daily market analysis, Twitter for the latest from the Bureau, Instagram and TikTok for behind the scenes, and finally, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. So be sure to find that page if you want all that good stuff. If you guys liked this guy's video, share the love. Hit the like and tap the subscribe. Ping that bell as well for good measure. You don't want to miss what else I have coming. I hope to see you guys real soon, but until then, this is Guy bidding you goodbye.